So what we're going to do today is kind of talk about banking and savings and checking accounts. Okay. And so we're going to go in and take a look at a couple and see what are the key characteristics that you should look for. Now, show of hands again, remind me who has currently a savings account? One, two. Nick, do you have a savings? Three. Okay. Oh, Donovan's here too. Okay. Hey, Donovan. All right, so let's take a look at what we're looking, or at a basic savings account and what you should be looking for. Now, I got another question for y'all. Those of y'all who raised your hands for savings accounts, how did you choose your savings account bank? The bank for your savings account? Parents? Parents for the rest of y'all too? Okay. What's one of those things, or why does having a bank with your parents, why is that helpful?
Because they have more
They have more what?
experience.
Okay, they may, yeah. Do any of y'all's parents give you money? Have they ever transferred money to your savings account for you? No. Donovan's shaking his head. Okay. All right. Well, as you go off to college, some students in college get kind of an allowance from parents while they're off. Or let's say an emergency happens. How many of y'all have parents, or how many of y'all's parents would help you cover an emergency if you're in college and like your car gets wrecked and you need some cash? All right. So a couple of hands. Having your savings account at the same bank that your parents bank at makes that transfer pretty easy because they can do it and it will be done that same day. Okay. But as you get older and you may say, you know what? I want to, there's a different bank out there that's meeting my needs. Okay. So we're going to take a look at some of these characteristics. Which bank do y'all want to go to? Bank of America. Okay. So, all right. Okay, so here we have checking, savings, credit cards, home loans. Okay, so we're really only going to be focused right now on the savings aspect and the checking. And let's start off with savings. Um, so savings is going to be one of the things that it's the starting place for a lot of people. Okay. In fact, they have child savings here. So a lot of times your parents will go ahead and open up a child savings account. Let's see what the age requirements are for here. I'm thinking under the age of 18, but let's see. Yep. No monthly fee. Ah, come on. Okay. It's a minor savings account. Savings for now help a child build savings account, learn about baking. No monthly fee if the child is under the age of 18. Okay. So this is one option here uh, for a lot of y'all. But one of the things that you have to be mindful of is, it says no monthly fee for a child under the age of 18. So the moment you turn 18, they're going to start charging a monthly fee on that. And you're going to start seeing your money disappear month by month. Okay. And if you want to have an idea of how much the monthly fee could be, this one over here, $8 a month. Okay. Fees. Okay. Well, at age 18, the minor savings account converts to a Bank of America Advantage savings. So let's take a look at that one. How many of y'all bank with Bank of America? Okay, Nick. I used to. I canceled it. Okay, so one of the things that we look at that you want to pay attention to with your savings account is interest. Okay, now interest. What do y'all know of interest? When you hear the word interest, what comes to mind? Okay, more money over time. Who tends to pay interest? The person borrowing money or the person lending money? Borrowing. Okay. So when you give your money to a bank like Bank of America, you are essentially being the lender in this situation. Because what does Bank of America do with your money? Do they keep it in a vault? No. They take that money and they lend it out to other people. Okay. So if someone applies for a mortgage or a car loan, they will give that money. What was someone come in? No. They will give that money to those people, right? So they are borrowing the money from you. When you deposit the money in, you're being the lender and they're being the borrower. So they're going to pay you interest. Now, as the lender, do you want your interest rate to be high or low? What do y'all think? As the lender, you're lending me money and I'm the borrower. I'm going to be paying the interest. As the lender, do you want the interest rate to be high or low? High. If you're borrowing, do you want the interest rate to be high or low? Low. Okay. So we want high interest rates in our savings accounts. We want low interest rates on our loans, but high interest rates on our savings. Okay. So let's take a look at the rates first, since we're on that. That's not much. Okay. That is 1/100th of a percent. So if you were to put that out in decimals, further. Let's see. It would be that 0.0001. Okay, so if you had $100, how much interest would that give you per year? 1 cent per year. Is that a lot? No, you could probably get more money picking up change off the street than you could with $100 in this type of account. Okay. And so $2,500, you're going to get 0.01. Over 2,500, you're still going to get 0.01, unless you qualify for these. But these qualifications come with additional fees. So let's take a look at the fees on that. Good memory. Okay. So to open up an account at this bank, you need to have $100. Okay. Not all savings accounts, banks will require a $100 initial deposit. Okay. Some require 0. So you could open it up with as little as $5. Okay. One other thing here, there's a withdrawal limit. So all savings accounts, all of them, are going to be limited on how often you can take money. And it's pretty much standard that everyone is limited to 6 withdrawals each month. Okay. So if you start taking money out of your savings account more than 6 times, Bank of America applies a $10 fee. Don't do that, right? But that's an optional fee because you have to do something in order to pay it. Mandatory fees are things that you could just let the money sit there and you're going to pay no matter what. So a mandatory fee here is $8 per month, unless you qualify for something for one of these exceptions. Okay. Maintain a minimum daily balance of at least $500. So you need to have $500 in your account every day for the entire month. If you're ever going to dip below, don't do this one. Okay. Link it. Let's see, Advantage Relationship Banking. I think that applies to a checking account, possibly. Okay. For new, they'll waive the fee for the first 6 months. That's nice of them, but yeah. And then you may also get a waiver if you're a student enrolled in school under 24. But just pay attention to this because, I turned 24 while I was in law school, and I still had my Bank of America at that time. And then I started getting, I forgot about it. I started getting hit with the fees for it. So one of the things I did was I transferred it over to an online Bank of America online, but then they were going to charge me a fee every time I went into the bank to deposit money. Kind of crazy because I would speak with a teller, and that's what the bank deal was. Okay. So things to look for: your fees. Okay, you really want an account where you're not going to be paying $8 a month. Okay, or monthly fees. Okay, so you want to watch the fees, and you also want to watch your interest rates. Low fees, low to no fees, higher interest rates. Okay. Next up, for the savings or for the basic accounts, is checking. What piece of plastic is tied to a checking account? Not credit. What's the other one you hear about? Debit. Okay, debit with a D tied to the checking account. Credit cards, you're borrowing money in the immediate term and you just have to pay it off at the end of the month. Debit cards are drawing directly from your checking. Okay, and there are a lot more fees associated with a checking account that you have to watch out for. Okay, let's compare the options here. Okay. Minimum opening. Okay. Now the monthly fees, you can kind of see it. It's gone higher for the main 2 ones. We'll take a look at what makes this one Safe Balance Banking special. But in their main one that they sell or that they push, it's $12 a month. Okay. Minimize this over. Okay. To avoid the monthly fee, okay, for this one that's $25 a month, you need to have a balance of $10,000 with Bank of America. That's a lot of money to have just sitting in cash, especially when you're starting out. And when you first get your jobs after college and you have access, you've earned this money, I'd be recommending that you put it into and start investing it. Put it in an investment account and start investing. Okay. So this account's going to be kind of off the limits for a lot of people. Over here, to avoid the $12, one qualifying direct deposit. What's a direct deposit? How many of y'all have heard of direct deposit before? Okay. Donovan, what do you know of direct deposit?
Not much.
Okay. Anybody else? Who turns the money into the bank? The owner of the, well, so that would just be a regular deposit. Direct deposit happens when you get your first paycheck paying job. You will sign through the hiring process, you'll fill out all of these forms. And one of the forms is going to be your direct deposit form. You're going to give your new employer your bank account number, the bank account's routing number, which is just it's essentially the digital address of the bank. Okay. Not the physical address. It's the routing number is going to be different on that, right? And your account number. And they will take your paycheck, and instead of giving you a physical check that you have to go to the bank and deposit, they're going to take that check and they're going to send it straight to that account. Okay. So like I have direct deposit set up here at Westbury, and we get paid at the 15th and the end of the month. Okay, so halfway through the month and the end. If the 15th falls on a Saturday, we'll get paid that 14th, the last business day. Okay, so the 14th or 15th and the end of the month, direct deposit shows up typically around like 3 a.m. that morning. My paycheck is in my account. Okay, so you have to have qualifying direct deposit of $250 or more. Okay, so if you have a job that you're getting paid regularly, you'll probably get this fee waived. Okay, or you can maintain a minimum balance of $1,500. That's a little bit high, right? So I'd probably rather not. Or you could be under 24, enrolled in school. Okay. Paper checks. How many of y'all still use paper checks? Or how many of y'all see your parents use paper checks? So, personally, I have not used a paper check in probably 10 years. Right? Paper checks are kind of going bye-bye because now with our smartphones and apps like Zelle here, which Bank of America uses, you're able to send money electronically without having to write out a check. And a lot of places don't take checks because there's a chance that you could write a bad check, right? Where you write a check and there's not enough money in the checking account to cover it. Okay. But each of these comes with a debit card. Okay, we can do Zelle, paper checks. See, you also have to purchase them too. So that's another thing that it's going away. Okay, interest. They typically don't. Checking accounts, your main checking accounts will not pay interest. Why do you think that is? What are the odds that you're going to use money in your checking account? Pretty high. Can you call on that money at any time of the day, any number of days throughout the month? Yeah. There are no limits to when you can call on that money, when you can take that money out. So if someone if a friend of yours gave you $100 to hold on to and said, hey, I'm going to call on you throughout the day and just like ask for that $100 back, are you going to keep that $100 on you if you have to pay him back at any point in the day? Yeah. Or any point in the month? Yeah. You're not going to put it in an account or do anything with that. So your checking account, banks tend to hold for them like at the location. they're not going to loan it out because at any point, people who have checking accounts call on that money, right? So because they're not loaning it out, they're not going to give interest on it. Your savings accounts, yes, you could call on that at any point, but you're limited to how many times? What did we just look at? How many times are you limited?
6.
6. Yeah. So they can lend that money out, earn some interest, and pay you some of that interest. Okay. But your checking accounts, that option's not there. Okay. This is where a lot of people who aren't smart with their money end up wasting money. Overdraft policy and fees. Okay. So overdrafting is the practice of, let's say you have $200 in your checking account and you buy something that's $210. All right. You have overdrafted that account by $10. Now, typically, let's say what could happen. Banks are open Monday through Friday, regular banking hours, and then Sunday a little bit, right? Or sorry, Saturday a little bit. Let's say Saturday afternoon, you have $200 in, you spend $100 on your debit card, that gives you $100 left, and then you spend $110, 2 separate transactions, 100 and 110. Both transactions will go through because you had $200 in, but that second transaction is going to overdraft you. And when you overdraft, you're going to end up getting hit with a fee, $35. Okay. And that applies to each item that you pay into overdraft. So the first $100 is cleared. It's fine because you had enough. Second $100 is actually going to cost you $145, or sorry, second $110 is going to cost you $145 with the fee. And then let's say you go down to the vending machine and you buy a candy bar for, well, I guess they're not opening, they're not operating right now. Yeah, but gas station, buy a candy bar for $1.50. That candy bar is actually going to cost you $36.50. All right. This will kill your, just eat away. And it'll just keep on gathering fees until they eventually decline the card. But you're still on the hook for those fees. Okay. So that will kill it. Okay. One other account I want to take a look at. It's a different type of savings. And this is on the initial survey I gave y'all. I put it on there as CDs. Okay, and we had some, there we go. We had some, you know, when you typically first hear the word CD, what do you think of? Compact disc with music or data for the computer, right? Here, CDs stand for certificates of deposits. And essentially what they are is they're long-term savings accounts that kind of lock in your money. So you open up a CD, you can get one for a period of different time periods. Let's say, all right, 7 months to 37-month CD. And so when you open up the CD and you put money in here, you cannot touch that for whatever period of money. You are essentially locking that money in. Now, if you're locking that money in, what do you think should happen to the interest that you're going to get paid? First, if you're locking that money in, are you giving up some rights to that money? Yeah, you can't access it whenever you want. You're giving up some rights. And so if you're going to give up some rights, what should the bank do in order to compensate you? How do banks compensate us when we give them money? When we deposit money into their bank? Interest. So if we're going to deposit money into their bank and we're going to say, hey, Bank of America, I'm not going to touch this for 28 to 10 years. Bank of America is going to say, thank you, Nick. In exchange for you giving up your rights to this money for 28 days to 10 years, we're going to compensate you by giving you higher interest rates than a regular savings account. Okay. It's still your money. They still have to pay it to you, but they are giving it, like, they're going to give you more interest on it. Okay. So feature CD account, I mean, you look at that, $10,000 minimum. Over here for a standard, it's only 1,000. Say only 1,000. Other banks are going to have CDs that you don't have to open up, or the minimum opening deposit is $0. So you could open up one and fund it with $100 if you want. Okay. Annual percentage here, 0.03%. Okay. What was it on the savings account? Anybody remember? Huh? 0.01%. Yeah. 0.01%. So this is offering 3 times higher. Better deal? Yeah. Okay. When's the only time that you should open a CD account rather than put the money in savings? If you're not going to touch it for a while. If you know that you're not going to touch it for a while, open it up. Now, you can touch it. Okay. There is a, like, if worse comes to worst and you needed to pull money out of the CD to cover bills, you could do that, but you're going to get hit with an early withdrawal penalty. Okay. So let's say you put $1,000 in the next month. Let's just see. Say we did a 12-month CD for $1,000. Okay. You put $1,000 in 12 months. 2 months later, you need that money. You may get back less than what you put in it. You may get back $990. Okay. But you can still access it. So you only touch it if you have no other choice. Okay. Puts a little barrier between you and that money. Okay. Does anybody here bank online? Like use only an online bank? Adriana, did you say you use Capital One? Yes.
Sorry, were you asking me?
Yes. Did you say that you use Capital One?
Yeah.
All right. I want to take a look at Capital One so we can compare. This is actually the bank that I bank with now. So hopefully it doesn't automatically log me in. So Capital One, they do have some locations, some physical locations, but they mainly do a lot of online banking. So if we just take a look at the CDs, since that was the last thing that we looked at. Your online banks are going to have higher interest than your physical banks. Why do you think that is? Why would an online bank have pay you more interest than a traditional bank. What do online banks not have to do? Okay, physical locations. What expenses come with having a physical location? Rent, okay, rent. And if you own it, what do you have to pay every year to the government? Property tax. All right. So if you're a bank, you're going to pay property tax every year. To open, what do you have to? You have to turn on the lights, right? Pay electricity. You have to pay people to be there. So more employees. Okay, so you have all these other expenses that come with having physical locations. If you're mainly online, you don't have these physical locations, so you're able to cut costs and pass that savings down. So for a 1-year CD, you remember Bank of America was going to pay 0.03%. Capital One, 0.2%. Still not a lot. I mean, I remember last year, prior to Corona, I was getting CDs for 2%. And then it just started falling. But 0.2%, that's 7 times more than what Bank of America is offering right now. Okay. Now, one thing with these banks that you want to take a look at, you want to be sure that you're choosing a bank that is FDIC insured. What do you think? Anybody know where FDIC insurance comes from? The origin story? How many of y'all remember or learned about the Great Depression? Yeah. What happened at the beginning of the Great Depression? It's also portrayed in the movie It's a Wonderful Life. In case y'all have watched that. Stock market crashes, people panic, and what do? Taking all their money out of the bank. Okay. Now, do banks have all of the money in their vault? No. So if a bank can't pay out the money, guess what they do? They shut down, they fail, they go bankrupt. A bank can go bankrupt. So if a bank goes bankrupt, and we see banks go bankrupt and people's money gets, boom, lost. How many of y'all would trust a bank to put your money in? Like, again, would you ever trust it again? No. So what the government did, because we want people to trust banks, what the government did is they passed FDIC insurance. And it's Federal Deposit IC. I'm not sure what the IC stands for. But essentially, if your bank goes bankrupt, the federal government will reimburse your money up to $250,000, okay, per account type. So if you are married, you should, and you want to have the maximum amount of money protected by FDIC insurance, you can have 3 different account types. Yours, your spouse's, and a joint. Each 3 would be $250,000. Okay. If it was just you and you had $250,000 in a savings account and you opened up another savings account with the same bank, that won't give you extra protection. It's still 250 because they're the same type of account. Okay. So what do you think would happen if you had $300,000 in a savings account and your bank goes bankrupt? What would happen? How much money would you get back? You had $300,000 in, your bank goes bankrupt. Huh? Okay. You would get some money back. How much? Up to $250 protection. And you have $300,000 in. It's not a trick question. Okay. 300,000 minus 250, what is it? 250,000. Well, oh, no, sorry, I meant thousands. So $300,000 and you have $250,000 or $250,000 protection. And you have $300,000 in the account. How much money do you get back? That's how much you lose. You get 250. You get $250,000 back, but you've lost that $50,000 extra, right? So if you do have $300,000, break it up, put it in different banks, okay? Don't put it all in the same bank account, because if that bank goes bankrupt, and in our lifetimes, we have seen banks go bankrupt. Great Recession, 2007, 2008. Do y'all remember hearing Washington Mutual? Remember hearing that bank, Washington Mutual? No?
I recognize the name, I don't know what happened.
Okay, that's all, like, you recognize the name. What about Wachovia? No? So Washington Mutual and Wachovia, those were both banks, nationwide banks, that went bankrupt in the Great Recession. They got bought out by banks like Wells Fargo and Bank of America. Okay, so the people who had their accounts with those banks, when they went bankrupt, their money was safe up to $250,000. Okay. All right. Any questions over this? I'll post a little worksheet to kind of go through this, and we'll have this recording saved so that if you wanted to go back and review some of this